All right. I think you guys can hear me correct? Yes?
Yep.
All right, perfect. Just give it a minute or so here. And Jess, you're there?
Yes, Annabelle, I'm here.
Fantastic. Very good. Well, welcome everyone. Hope everyone had a great Thanksgiving.
We did. Hope you did too.
I did. Thank you. All right, well, we'll get this started. Let me just here. Anyway, all right. Well, good afternoon. And for those of you that don't know who I am, my name is Annabelle Pacheco, and I am a real estate investor and a broker. I've been in business for 24 years, and I am part of a global real estate company called eXp Realty. And really the goal for me to do this call every week is to just kind of share with everyone the steps that I took in purchasing my first multifamily deals. You know, what I did, where I'm at today, also bringing guest speakers from the multifamily space to share with us, and so that we can expand our knowledge, and also you know, just give us enough information that you guys can go out and do this yourselves. I encourage everyone to participate, ask questions. This is a really safe platform. I mean, it's, you know what, no one's here to judge, and it's just to share information and learn, and how we can grow, and you know what, how we can go out there and actually be part of this multifamily space. I am not selling anything. I'm not offering anyone anything at all. And I am for sure not a financial advisor. I am just sharing my story with everyone, and in hopes that, you know what, it inspires you guys to go out and do the same thing. A little bit about myself. I started in the mortgage industry in the mid-90s. I purchased over 100 properties throughout my career. And in about 2001, we built deviated a bit from real estate, built a 150 capacity restaurant from ground up. It had a staff of about 15 people, including managers, chefs, and servers. And really, that was for a good solid 8 years, and super happy I was able to sell that and turn over the keys to someone else, because that's definitely a demanding and very sacrificing business. But you know what, it gave me an opportunity to really appreciate real estate. And I love real estate, and it's something that I can do for a long time. And I'm learning, and I'm expanding, other than just representing both clients in, give me 1 second. Someone's trying to get in and they cannot get in, and they're texting me. Jess, are you able to help out on this?
Who needs to get in, and what's the problem they're having?
He says that it's showing that there's another meeting in progress, and it's our guest speaker.
Annabelle, I'm gonna private message you in Zoom a link to send to him.
Okay. Go ahead and do that. So let's see, where was that? So anyway, you know what, I represent clients both in the residential commercial space, and in 2015 I decided to go out and purchase my first multifamily deal, which was 34 doors in Texas. So give me 1 second. You want me to send this link to him?
Yes, yes.
I don't, okay. It's gonna get me off of my screen. Hold on a second. Can I give you his number? Can you send it to him?
Yeah, that's probably gonna take me like several minutes to get the link off of my computer onto my phone, but yeah, you can text it to me and I can send it to him.
I can't do that right now. Okay, it's 407-808-3333.
407, what?
407-808-3333.
Okay, thanks.
Thank you. I apologize. All right, so where I was at, let's see here. So, okay, so purchased my first multifamily property, was 34 units in Texas. And how did I decide to go to Texas? I had a mentor who had already purchased in Texas. So he had already done all the research and he studied the market. And I knew I was not about to reinvent the wheel. He'd gone there, I trusted him. And so I decided to go into Dallas. And you know what? We went in there and it just made the process a lot easier for me because I knew specifically where it was that I was going in. And I was at a point in my life where I was looking for a way to create cash flow and generational wealth. You know, I was kind of done with just the rehabbing, flipping properties. I mean, it's great, don't get me wrong. It's an excellent way to create capital. But I think, you know, as we get older and just as, I don't know, you mature in business, it was kind of like, all right, I need to figure out now, you know, we need to step it up and figure out, okay, how are we going to make our money work for us? And so here are reasons, you know, everyone has different reasons. And I'm going to share with you guys, like, what were our reasons? Okay, we were looking for cash flow. And I thought, okay, you know what? We buy 34 doors. There's definitely an opportunity to create that cash flow, right? Because you have multiple doors. And you don't have to worry so much if maybe 1 or 2 or 3 units, for whatever reason, don't pay. You're still covering your, you know, your mortgage, you're covering your expenses. Maybe it taps into your cash flow, but it's there and it's, you know what, it's working. Number 2, it was, I thought, like, what an incredible opportunity to actually have tenants pay down your loan, right? Every month they're paying down. I mean, the money you're collecting from rent is going to pay that mortgage payment. Number 3, it was appreciation, right? And it was, for us at that time, I did not see the appreciation as I do today. At that time, it was really about value add and cash flow. And I'm going to elaborate a little bit more on my next slide. So I knew that over a long period of time, this property would appreciate. And it did. It appreciated very well in the last 6 years. And number 4 was tax benefits, right? For me, it was, okay, depreciation. I can expense a portion of the physical structure each year from our taxes. And then there's that opportunity to do the 1031 exchange, which pretty much allows you to defer the capital gain taxes, and there is no limit to doing this. So these were my reasons. And I'm going to give you guys, I mean, a real life example of what happened to me. When we went out and, you know, we decided it was going to be Dallas, I was looking for a property that I could fix up and increase the value. Okay, so as I said in my background, you know what, we did a lot of flips. And so I was very used to going in there, rehabbing and selling those properties. I was familiar with, it just gives you a sense of, like, you just become very much aware of, you know, even the price of stuff and how long it's going to take. And, you know, as you're doing this a lot, you just become very familiar with it. And so we thought, all right, instead of doing 1 or 2 or 3 properties at a time, we now can do a big group of them, right? So here we have 34 doors that we purchased, and this property was definitely a value add opportunity. And for those of you that are on this call that don't know what value add is, it's pretty much, the property is not in good shape. It's in a decent area that if you increase its condition, you can increase the rent, and then the value of that property increases. And that's exactly what we found. And so here's my example. So we found this property on LoopNet. I happened to call. I was in Dallas at one of my, I did multiple trips out to Dallas for a week or a 2-week period, and just get in the car and drive around, become familiar with the market, meet different people. And it just so happened to be I was there when this property popped up on LoopNet, and I had asked my mentor who was there with me, and I said, hey, listen, this property just came up. What do you think? He says, you know what, that's not a bad area. And I said, all right, well, let's go look at it. I want to go see it. And when we went to see it, it was great. It was like perfect for us. So I reached out, contacted the agent, and the agent happened to be the owner of the property. So that was one plus, that was great. And then I am a buyer who happened to be an agent. So I'm interested in purchasing. So it was just perfect because I knew that the minute we talked and we connected, I was going to be able to make a deal with this guy. And he was very motivated. He needed to get out of this property. So long story short, I negotiated. I actually asked the seller if he would be interested in carrying a note, like just, like, would you be our lender? We have $350 available now, and we'll make payments every month if you could, give us 2 years. And he agreed. It worked out perfectly. It worked out great because those 2 years, number one, I didn't have to go through the loan process. And if anyone on this call is familiar with it, it's somewhat of a challenge. It's not easy. I mean, it's doable, but I was already stressed as it is. I'm getting myself into, my first deal, and I want to make it as easy as possible. And as long as it made sense, you know what? And it did make sense. He agreed to finance for us. And so we made payments for 2 years on the balance of $500,000. Now that allowed us to remodel and update pretty much, I would say we did about 70% of the units and increase the rent. Well, not a year or two, we probably had done maybe half of the units. And just with half of the work being done on the property, when we went to refinance, the property had doubled in value. So it had appraised at $1.6 million. And we were at a loan of about $1 million at that time. So we were able to get pretty much our down payment back and the cost, like just the repair money back. We have all of our money out of this property, and it's been producing for the last 6 years. Today, that property is worth $2.7, $2.8 million. So this is a really good example of the value add opportunity. Any questions, anything, regarding this that maybe you guys want me to elaborate a little bit more? We all good?
Can you explain a little bit, so like how the loan worked? So when you went to the seller, right? So walk us through that, because it's a little different than when you go through a bank, and I think it'd be imperative that people would understand how that all works.
Okay, sure. Hi, Chris.
Hello.
So pretty much, honestly, it was so simple. It happened. I mean, again, I was at the right time, right, and talking to the right person. It was simple because he was not running the property right. He was a slumlord, and he had a lot of problems there, and he knew that if he'd lend me 500, if he was the bank on 500,000, and now in order for this to happen, they have to have a very, very small loan balance or no balance at all. And in order for him to do this, it made total sense. He was making a lot more money collecting our monthly mortgage payment than he was rent on that property. Now, it really was simple. They didn't ask us for a whole lot. I mean, they asked us for proof of funds of the down payment. They did ask us for a credit report. And honestly, it was very simple. That was about it. he didn't ask or elaborate on a whole bunch of stuff. And then, you know what, put us in contact with the attorney that represented us both on the transaction and did the right paperwork. And obviously there's loan papers that they put together for us as the new owner, right, to pay them, and that was it.
The other thing, can you elaborate a little bit so people understand it? It actually makes the seller more money by doing it this way because their tax consequences are way lower.
Correct. So I mean, as far as if he would have sold this right at the 850, he would have had to pay. He would have either done a 1031 exchange, and there was I want to say that his loan balance was very small, so he would have had a big chunk of capital gain there that he would have been responsible to paying taxes. And so really this opportunity allowed him to not have to pay the tax. He waited 2 years, and then honestly, I mean, by the time we paid it off, at that point, I don't know. I mean, it's a totally different opportunity for him and for him to do his taxes. So I don't know at that point how it really works, Chris, but all I can say is it worked for me, and it was a great way for me to get an introduction into the multifamily world. And it just made life so much easier when I was able to have him provide that finance versus going through a traditional lender. I know that I would have qualified, but it would have been tough. They would have asked for a lot more. I mean, just a lot more stuff. And I can tell you from the time that we refinanced and we got I want to say a Freddie or either Freddie or Fannie loan, the guidelines are extremely, extremely high. I mean, they want specifically, like I had insurance, but I had, you know, maybe the basic insurance when he was when the seller was my lender. When I went through, you know, the traditional, I went through bank and I got a loan, I refinanced and I got a loan. I mean, my insurance costs went up tremendously because the bank wants specific insurance coverage that you have to have, and the cost is not cheap. So everything changes, right? I mean, insurance, and then they do you know, yearly inspections of the property, and they want to look at your rent rolls, and I mean, they're really, really monitoring and making sure that that loan is being, like, someone's taking care of it. So going this route was awesome. It really made life, I mean, that much easier, especially at a time that was really stressful because I was buying my first deal and it was out of state, right? And it wasn't 1 or 2 doors, it was 34 doors. So anyway, I am in the process of selling this property. I'm in escrow right now and should be closing hopefully by the end of this month or early January, but excited, you know, looking to grow my capital. I mean, we definitely have a nice profit that we've made from it, and I don't know, I'm just now being cautious, right, and trying to invest it again and figure out what would be the best way to do this so that I can grow that. And really, I think if something I could share with everyone on this call is how important it is to connect with other people in the multifamily space. This is the only way that we will learn and we become familiar, right, with the different, just everyone works differently. Everyone has different ways of running their business, and it just gives you an opportunity to learn, okay, this is something that I can implement in my business, right? I wasn't doing this, I can now implement this in my business. And I think that when I started, you know, in 2015, I wasn't exposed to the multifamily world. And honestly, Zoom and all these things weren't that at least I don't recall being so popular. And I really wasn't connecting with a lot of people in the multifamily space. It was just it was kind of quiet, right? Everybody's kind of doing their thing. I think in the last few years, we've started to see a lot of syndication and people coming together, purchasing like bigger number door properties, because it's just, the competition out there to pick up 30 doors or 50 doors or even 100 doors is not easy. So now you want to buy 300 plus doors, right? And you want to do this with a group of people. And that's why today I've invited Chris, and I wanted to kind of, number one, let me get my, stop sharing my screen here for a second. But so let me give you guys a little info on Chris. Chris is part of Cloud Capital. And he is really like just closely involved in the business of like raising capital and operations and marketing of the company. And something that I think is really important is just his background. He's been involved in general partnerships and limited partnerships in the multifamily space, which is great, something that he can share with others on this call. And most importantly is, the experience that he brings. He is, very experienced in construction, project management, and capital raising. So Chris, welcome to the call. I would love for you to share with everyone, what you're doing, this project that you're working on in Houston, that I'm extremely interested in, and just share it with everyone on this call. And welcome.
Hi, everybody. Thank you for that kind introduction. It's and I agree with Annabelle when she says that like we have to show this way of investing is not really taught in school. So I can elaborate a little bit on sometimes like banks will reject you. Always ask the owners if they will self-finance, because instead of paying the taxes, let's say on $1 million, they're only going to be paid taxes on the payments, which are a lot less. And if you stretch that out over time, it'll save them a fortune. So there's a lot of different ways to finance a property, and that's one of them if a bank says no. And then the other way too is like bridge debt too. So you get a temporary loan, because sometimes, and Annabelle and I are of the same philosophy. We unfortunately we buy from slumlords who are just despicable people, and they're screwing their residents, right? Which is horrible. And so when you go in there, banks necessarily will not finance these properties because they're so run down and beat up. And normal people would see that and run away. But as real estate investors, those are the properties you want, because you're able to write off your rehab costs and infrastructure costs and against your taxable income. So for people that live in California, that's significant because we pay a heavy tax burden here. So if you could hide and shelter some of your taxes, real estate is a great way to do it. And it's a great way to do it because you can do it over years and then stretch that out. So it's a win-win for the residents. They get a new community or new building, new infrastructure, new exteriors, new, eventually renovated inside and everything like that. And then they're treated like as a customer. It's instead of like being treated horribly and living in squalor, basically. So when people see a rundown apartment building, those are the ones that you want, because when you buy like the A and the things that are all beautiful and stuff like that, you'll be able to make some money on that, but you're not going to be able to capture the big money and the bigger gains by doing that on the deals that are just terrible. So and the way we do it too is we treat our customers like gold. We don't ever want them to leave, because if they stay longer, then that's a lot less money for us, and then the turn and everything like that. So it starts by getting really, really good. And we rebuild the communities, because the one thing that's kind of sad is when you buy these from the slumlords is like, it's hearts and minds that you have to turn around, because they've been beaten down, and you'll see there's garbage all over the place. Things are literally like broken gates, broken pool furniture, and you can tell they just don't care. Things aren't painted, all these horrible things. So that's their mentality, right? Now, when you go in day one, like when we sign a property, we literally have, like, let's say it's 9 o'clock in the morning at some law office. We'll sign, and our team is literally right there on the street. The second we sign, I text them, go to work. And the first thing they do is pick up all the garbage and just start literally turning the property around, because they will see that their sense of value will go up as a person, right? And as a customer. And we call them residents. We don't call them tenants. People don't like to be called tenants, but that's kind of the way it starts. And we're really picky on who we let in, because we have to rebuild the community, because you unfortunately have to kick out some of the riffraff. There's people that are placed there, unfortunately, by the former owner that they shouldn't be there for a multitude of reasons. So unfortunately, that takes a little time. But then once you get those people out, and then you start building your own residence, we literally and build our community. That's where it starts to really snowball. And it's literally like a win-win, because you're giving the people the respect that they deserve. You're giving them a really nice place to live, and the community as a whole builds stronger and stronger. So because of that, that's the way to really build like long-term wealth. Those guys that are slumlords that are worried about, like, pennies and nickels, and they're just watching dollars fly out the window, because what they don't realize is this is in our apartments, when we have apartments that become renovated and then we need to lease up, we don't really send any money on the marketing side. We just tell our residents, and they tell their friends and or family members for us. So it's a win-win.
I was just going to say, and I'm sorry to interrupt you, but I was just going to say, that is exactly what I experienced, is that the minute we went in and they saw, I mean, like it was huge. We went in and it was like, okay, there's new sheriffs in town, because it was bad. There were drugs, just really bad people in there. And we came in and we didn't care. We said, okay, you know what? They didn't have a contract, and it's very easy to just say, all right, you 30 days, you know what? We're going to renovate all these units. And we kind of did it in blocks of 5s or 6, whatever we could do. And it was, and the tenants that are still there that we're not renovating yet see, oh, wow, you know what? They're working on this. Look, they're doing something really nice. And then a lot of the tenants we had in the 1-bedrooms decided to upgrade when they saw what we were doing to the 2 units. And obviously we gave them that first opportunity to upgrade. And it just, honestly, it makes a difference, because that community has maintained our apartments. We've had a waiting list for the last 4 years. And we've not had to spend any money on trying to get, to rent the units. It's just word of mouth. People are happy. They know other people that aren't happy, and then they come. And as long as we're doing we're strict as well, as we're checking their credit. We want to look at their background check, and we want to look at everything, make sure that they're going to be good residents and maintain and keep up what we've worked hard for and for everyone. And you know what? And they do. So I agree 100%. Makes a huge difference.
Yeah, I can give you a very specific example. So when I visit our apartment complexes, I will purposely park in the back, and I won't tell anybody I'm coming, and I just walk around. So the other day, we bought this complex in Texas City, which is just south of Houston, a little north of Galveston. But I just started walking around. One lady was sweeping her sidewalk. Another lady was planting flowers. And another person, they were all chatting. But when I went there the very first time, when we were doing our due diligence and stuff, there was garbage everywhere. People hated to live there. That, like, broken railings. There was a broken step on a stair, like that somebody could have easily fell and got seriously harmed. So there are all these things, right? And there was no flowers. There was no communicating between neighbors and stuff. And you could just feel it. And now when I went back and started walking around, if you saw the before and after, it's the hearts and minds that are great, because when you do all those little things, and it takes time, it's not fast, but once you get that done, then it's a beneficial to both sides on the equation. So it's a really good way to build long-term equity. And when you buy a structure, the way we work too is we do a quantitative analysis of the area within a 2 to 10 mile radius of the apartment complex. we want to have good employment opportunities for our residents. Because if they can work, that means they can pay rent. And unfortunately, like sometimes we get a lot of deal flow. Like we got this really good on paper deal that was presented to us in Tennessee that it was a home of a Nissan plant. That was the major employer of the town. Now, everything really looked really good on paper and it looked good. But when we flew there and I met with the Chamber of Commerce, it was Nissan, 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 Nissan. So when Nissan, that plant closes, or if that plant shutters, which they always do and retool and everything like that, all those feeder business around that will suffer. So for me, I thought that was too risky. So we walked away from that deal because it looked good on paper, but there wasn't enough diverse employment opportunities for our residents. So that is super important. So if they know that they're going to have ample jobs, they'll be able to survive. And so in our Houston deal that we have right now, it's called 506 South. There's 24 Fortune 500 companies within a 2 to 10 mile radius. So it's like basically a half-hour drive. So and that's another thing that I forgot. When we meet with when we decide on where we're going to purchase, we meet locally with the local Chamber of Commerce face to face, and they will tell you what's coming, what's going, what's leaving. You know, who are the companies that, you know, are flush with capital, who's growing. And you don't get that on the websites. You don't get that on the phone calls. You kind of, it's part of our you know, due diligence. And we really take copious notes when we do that. We find out a lot of information that we would never even think of. Like that one in our deal in Texas City, which is like, again, it's not in a major, it's in the Houston MSA, but it's a little north of Galveston. It's kind of in a, you know, a rural-esque type of a place. But the reason why we took that down is when we met with the local Chamber of Commerce, and I don't know if she was supposed to tell us this or not, but she did. She said, over the next 3 years, we only have 172 workforce housing being permitted as of now. But then she followed up with, there's 358 people that you move to the Houston MSA a day because the city is booming. So I was like, that solidified us to buy the deal, because within, like I said, within like a 2 to 10 mile radius of that place, there's a diverse employment opportunities of several great jobs. So, but so when I met in Houston with the Houston Chamber of Commerce, they're 7 years behind workforce housing. So 7 years. So when we get a deal, then, you know, that's super important that we know all that stuff, because then we want to know that people will be our customers and we'll have customers, and how many people rent in that community. All that data is available, and we go to uscensus.gov and you can figure out all that. But that's another super important thing. You don't want to buy an apartment building within a residential neighborhood where 92% of the people own homes, because then you're putting yourself behind the 8 ball. You want to stack the deck more towards you at all times. And then by doing it, again, it's not all unicorns and rainbows, right? So there's risk involved. So what you want to do, you want to mitigate those risks as much as possible. And all these crazy things could happen. And it's are going to happen. So it's not if, it's like a when, right? So when they happen, you got to have enough net operating income in the bank. And you got to have enough wherewithal and proper insurances, et cetera. So like when the bad things do happen, it's not going to wipe out your deal. So those are the things that we really need to pay attention to. And then there's a bunch of other things, but those are the base point of what you should look at. So I'm seeing a name in the chat by the area that we're looking into is in Texas. So we go where the jobs are. So this particular deal is in Houston, Texas, that we have. It's 506 South, but we also own in San Antonio, Austin, Jacksonville, Atlanta, and Texas City, and this will be our second complex in Houston. And again, we follow where the jobs are, and we also follow where it's owner-friendly states. And you know, I live in California. I know Annabelle does, and I would assume I know Yitzhak does as well. He lives in Santa Monica, but I don't know the others on the call. But the rules here are draconian for the owners in California, which makes me sad because I'd love to own in my own state, but I'll never do that.
Yeah.
So it's super important that you, not only do you give good customer service, but you got to have rules that are, fair and not just all one way. But the other thing too is when you do these deals, you know how everybody says it's a team sport. You got to have good team members. Like you got to have good lawyers, good insurance, good CPAs. And then we do a third party management because I don't want to be as a general partner, my partner and I, we want to be focused on how we can give the most returns back to our investors. And the way we do that is we want to manage the asset. So what does that mean? We want to figure out how we can get a greater return for our investors all the time. That's my job. That's Nathan's job. We hire a third-party management team. It's called Asset Living, and they're fantastic. They run the day-to-day operations, and they are, managing the leasing office. They're managing the maintenance staff. They're doing all the things that need to get done. So Chris and Nathan doesn't have to worry about a clogged toilet or any of those things that happen. We are trying to figure out, okay, how can we save water? How can we save on the electric bill? How can we get customers in the door quicker? How can we start those renovation processes quicker? How can we decide on a layout that's going to make it more user friendly for the resident? All these things. That's what we want to do, because when the residents stay longer, it's a win-win for everybody, because you're not going to have to renovate and or rehab that structure. So, and then the next thing too is that when you're doing these deals, you always want to make sure that the way that we do the deals is you want to make sure the sponsors have skin in the game. So when you take down your own deal, I always include a lot of my own money, because I want to make sure that not only I'm working hard for me, I want our confidence in our investors to make sure that they know that we have actual money in the game, because that will give them confidence to know, like, oh, okay, if they're putting their own money in too, we'll do so as well. So, and the risk mitigation too it's so important. It's so important. We go in and we underwrite, what's the worst case scenario? What happens if, what's our lowest occupancy rate that we can manage to retain and to make our monies for our investors? So, and that's being really, really conservative. So you have to underwrite thinking like at least there's going to be 9 to 12% that people that are not going to stay there. So, and then when that happens, or, when you're better on that, it's a better return for your investors, because you're not over promising, right? So, but you will over deliver, because you'll give a higher return and a quicker return back to your investors. So, and if you'd like, I could walk you through our deal. I don't know what people need.
Yeah, I mean, if you can,
about.
not so detailed, because we don't have enough time, but
Yeah.
if you can give us a general, like just a general synopsis of this deal, I think it'd be great for those that are on this call to see what's out there.
Yeah. So the deal, again, it's in the Webster, Texas. It's in the Houston MSA. It's 2 miles away from NASA.
You want to share your screen?
Oh yeah, I can do that. Sure.
Okay, yeah, feel free. Eric, as soon as this call is done, everyone gets a recording of the call, the webinar.
All right. If you guys can see my screen here. So this is the property overview real quick here. So it's in Webster, Texas. It's a section of Houston. So the occupancy rate is 98.9, which we were hoping for a little lower. And when people usually say, oh my gosh, don't you want 100%? Not when we buy it. We want as many empty units as possible so we can start the renovation process. So we'll start that renovation with the empty units, and we'll continue with our game plan. This is some of the rentable square feet. Is always something that you always got to pay attention to when you look at the deal, because sometimes there might be spaces that are empty, that are not being used. So you got to either figure out how I can make that space. Sometimes there's closets or sometimes there's game rooms that were a game room back in the day that aren't being used. So you always got to pay attention to that to see how you can either reinvent that game room or make it into an apartment and/or office, or a serviceable way where you can really maximize your return. So here's the floor plans, and here are the units, and this is the in-place rents, right? And the reason why we're buying this deal is the present owner is on average $268 below market rents, which is crazy because he's never stepped foot on the property. So we're going to go in there, we'll renovate, and we'll bring up these rents up to market. So, and these are the floor plans, and these are some of the amenities which we have to rehab and paint and clean and do a lot of the things that we discussed earlier. So the other thing too is for your first deal, try to get a pitched roof. Try not to do flat roofs in Texas or Florida. They're a little more troublesome, but your third and fourth deal, you can make that not so much, but of a concern. So this is what this is what the apartments look like now, and it's kind of like the 1980s. So this is the exterior that needs landscaping. We're going to cut the trees that are growing into the buildings. We're going to rehab, new playground equipment, paint, everything that's well needed. And we always say this is for our returns for our investors. They'll get an 8.1 cash on cash. They'll exit multiple of 1.78, and then a 23% initial rate of return. So, and again, here's the way we break down the deal further. This is the purchase price, this is the equity. We're going to start with 1.4 million. It's probably going to go up closer to 2. And then we're going to hold. This is going to be a shorter term hold, but it's either we're going to hold it or keep it and cash out refinance. Which means, like I give an example of one of our other deals we bought for 10 million. We put 2.9 million into it. We refinanced at 16.9 million. And that delta went all back to the investors as a non-taxable event. So a lot of the people got their initial investment back, and we're just playing with house money, so to speak, for 3 years. So. But again, this is the reason why we're taking this. It's totally mismanaged. It's ideal locally for families. There's a high school. It's literally right next door to it. A grade school's right down the street, 3 blocks away. They can walk. There's a church right across the street. We're really concerned about our safety of our residents, so we always go in and put cameras all over the place. There's a police station that's literally on the same street. And then again, massive below market rents. So you can see the deltas here: 169, 290, 156, 308. If the guy ever stepped foot on property, he would have seen that or just paid attention. So the great thing is we're getting this deal off market, because if it were to hit on market, it would probably go for like 106 a door, but we're getting it for 98,889 a door. And these are our comps right in the same neighborhood. 2 of these are on the same street, and they're right around. The rest are right around the corner. So the importance of broker relationships is always really, really strong. You kind of want to know if you can close, they're going to keep coming back to you again and again, because they'll know that because the broker relationships, just so you guys know, they'll sell maybe 4 or 5 complexes a year, as opposed to like a single family home seller who might sell up to 20 and 30 homes a year. So they want to go to the people that are going to close, because if they close, then they know that they're going to really make it easier on their end. So and another reason, so we took Houston down because, again, we look at data all day long. That's all we do. We take hearts and minds out of it. The numbers say yes, we do it. So it's it's the number 2 population growth, 4th largest city, 7th largest GDP in the nation. Just last quarter this year, it's 1.26 billion in venture capital. So that's awesome. So again, it's 24 Fortune 500 companies. It's a great state to start a business. Employee growth is at, the number 6 in the nation. So again, and like I said before, this is proof. I don't have to stay too long on this. Of they need workforce housing. So basically, this graph tells us is we're buying this to give workforce housing to our residents, and they're way behind. So, and the migration train, U.S. migration trends and income trends. Again, we want to pay attention to the numbers so we can see everything that's coming down. So we'll know, okay, these are the cities we want to invest in, because that's where the money is going. You want to follow the money. And then this is just to show everybody, not only is there good jobs within the area, there's a lot of cool things to do that are anything like, 20-minute, half-hour drive. So whether you want to work, indoor play, it's centrally located. And this is just to reinforce what we discussed before. We're presently charging $1 per square foot for rental, and the submarket is 1.26 here. And, all these things point to exactly why we wanted to take down these deals. So, and it's a 55.5K median income, which is super important. And when you do your investments, make sure you do 50K and above, because that's the magic line for where people really kind of start really caring about the properties. Under 48, it gets a little dicey. So again, you want to stack the odds in your favor as much as possible. Again, these are the employers that are right around the area. And so again, if they have ample employment opportunities, they're going to be able to pay rent. So, and these are the examples. This is the model that we saw, that we see it. And so if you were to invest 100K, you'd have an exit multiple of 1.78 year. So almost doubling your money. So, and so once the turn starts, then after that'll take you about 6 months, 6 to 9 months, depending on how bad things are, to stabilize the property, and you'll get quarterly payments of 8.1%. So, totaling up to, the 23% of initial rate of return. So, and then the rent roll analysis is super important. When you break down the deal, you got to make sure that you're looking at the rent rolls, and then you compare that to the bank statements, and then you'll know if somebody's fudging the numbers. So these are the in-place rents, these are the target rents, and then these are the bumps. And then again, not that this is a lot of money, but over 180 units monthly, it turns into a lot of money. So that's important. So like even $25 or $50, it times 180, it becomes a huge amount yearly. So we broke down the pro forma deal, lost a lease, and, basically this is the proof that we've done to make those last few slides. So it's not just me willy-nilly thinking all this stuff. We have a very complicated formulas and spreadsheets where we actually want to make everything work, and we know where every penny, and I say every penny, is going, because then once you do that, then you'll know if your property is really going to be good. So, and again, this is just a financial overview, kind of went over this. We're going to get the loan for 13.5 here. We're going to renovate for 1.4. We're going to have working capital of 314,000. The term on the loan, this is a bridge loan. It's 3 years with 2 1-year extensions. And we also bought a cap. I don't know if you guys know what that means. So we're getting, the interest rate is at 3.8%. Now, if the interest rates goes higher, we bought a cap that it will not go higher than 3.8%. So again, to further protect our investors. And then these are the financing deals. It's 3.8, like I just said. It's interest only. It's for 3 years and 2 1-year extensions. And then we'll either sell year 3 or 5 or 4, and or keep it and cash out and refinance. So the annual debt service is super important when you look to buy a complex, to make sure that you can finance your operations and have enough money in the bank to pay the loan. So and this is the equity structure. The way that we do our deals is everybody is paid on $1,000 per share. And whether you're Class A or Class B, it's all paid on $1,000 per share. The B structure is to set up the sponsors of the event. So the sponsors of the general partnership. Sorry, I couldn't think of that real quick. So, but we're paid out to on the $1,000 per share. There's other deals out there, like if people put in 500,000 and I put in 25,000, they're going to get 10% back, and I'll get 7%. We don't do that. We think that's not fair. We want everybody to win from the structure being repurposed. So these are some of the comps in the neighborhood. Just again, further proof on why we're purchasing this property. We just didn't do it willy-nilly. We went out, we toured the other properties. We saw what was good, what was bad, and why we want to take this down, because we're going to bring this up to market and it's going to be a win-win for everybody. This just goes through the comps in the neighborhood real quick. And then, and these are our, growth assumptions, just so we know, okay, we're not going to say everything's perfect all the time, but we're going to have the base case, the high growth and low growth. But even with the low growth, we're still going to do okay. And this is just kind of wrap up of everything that we discussed. I see the clock is ticking, so I'm going to go through this fast. Basically, we're going to renovate, watch our expenses, lower the electric bill, implement our water conservation programs with the smart valve, shower heads, low flow toilets. We're going to come in, pump a lot of money in there, make that place beautiful as it should be. We're going to do a marketing plan that, that's very, very, robust to make our residents want to live there. And then we're also going to do resident retention. We do a lot of things for our residents, pool parties, Halloween parties, Christmas parties, and we want to make that a great living experience. So again, the hold is going to be there for 3 years, or we're planning on selling and or cash out, refinance, and then we'll keep. So and then, these are the planned interior improvements. This is now, and this is what it's going to look like afterwards. And we hired a designer to come in and make it look modern and make it look beautiful as it should. So this is the renovation budget summary, where we literally have down to the penny where that money's going, from the concrete repairs to renovations, plumbing, roofing, etc. And then this is what we do for our timeline. So we started this the whole process in September, and then we did our due diligence in October. We got all our paperwork done, and then we were closing on the 8th. So, or excuse me, the 14th now, the 14th. So, is there any questions or anything like that?
Hi, yes, Chris. I'll briefly, I just flew in actually from Houston just 3 hours this morning. I was looking at converting possibly a single family ranch to a multifamily unit. Galveston area, I pretty much know. My friend of mine just became pastor of a church there. But my concern, our question is, did you take into account the flooding and everything that occurs in that area? When you
Absolutely. So like when we do a geo, it's called geo, we basically look at the earth, right? And then we hire a consultant to go in there and really make sure that we're not in a flood zone, what can happen, earthquakes and everything else. And yes, so this isn't in a flood zone. So but we do have proper insurances. We have business replacement insurance. And we also have, it's called new stick or rebuild insurance. So if the structure should get damaged in any way, we'll get paid out up to, I think it's $200 million. And then if the structure should get destroyed in any way, it will be rebuilt in current day dollars.
Okay, thank you.
Great, wonderful information. Chris, can we share the deck with
Oh, yeah.
those on the call today?
Yep, I'll upload it in here. So.
That would be great. And Jess, you probably can also add that to the email that goes out. All right, any questions? I mean, that's definitely a lot of information, but I think this is great for you guys to become familiar with, you know, I mean, this is an actual real deal. What you have to look at and what's, you know, I mean, everything is important, right? But there are certain things that are probably a little bit more important than others that you want to pay attention to. And I think that if you guys take a look at that deck, and I mean, if anyone's interested or has any questions, feel free to reach out to Chris. Chris, you might want to put your info as well. I mean, it's on the deck, but you might want to also put it in there. Perfect. Yeah.
Just was touching as we spoke.
How do you reach out to me when you have a deal for multifamily? Just email me or call me. I mean, I think you have my when you register for my emails, you should have access to my email. I can put my phone number on here as well, and feel free to reach out. Right. Any last minute questions? Anyone, you know, maybe stuck on something, or maybe you're interested in investing in this property? Any last minute questions? We've got like a couple minutes.
I have a question.
Sure.
How do you GP a project in Houston from California?
So when you want to be a general partner, or just if you want to invest, I hear people that say, oh, I only invest in this market, I only invest in that market. It's ridiculous. You want to invest where the money is. So
Right.
we research a lot, and I just pay attention to the numbers. And we have a third party on-site management team. It's called Asset Living. And they do the day-to-day operations. So I can look at the overall picture, and my partner and I, we want to figure out specifically how to maximize our investor returns. How can we keep our residents happy so they stay longer? It's super important.
Perfect. Is it, hold on a second. Is it Marif? Marif, you have, you'll get an email right now. As soon as the call is done, you'll get an email with the property information. You can feel free to reach out to Chris directly.
Yeah, Marif, call me if you want. And the other thing too is everybody, like people were
call.
really kind and showed me a lot. So if I can help anybody. And the other thing too is when you guys do this, go slow, read, and then read some more, read all the contracts.
Yep.
Highlight everything that you don't understand and ask your lawyers or CPAs or try to look it up, but don't just assume either. Just please don't assume, because there's sharks out there and you want to make, yourself protected at all times. And it's okay to ask questions. I ask questions out the yin yang, and I'm not going to tell you I know everything, but
Yeah, neither do I.
Yeah, I have really good teammates that do. So, and I know they roll their eyes. Like our lawyer doesn't really like me because I ask her a lot of questions, and I feel her eye roll. She's great, but I'm like, hey, can you explain this like I'm a fourth grader?
Yeah.
And actually, it's invaluable.
Yeah, I agree. All right. Well, awesome, Chris. Thank you so much. This was great. I mean, I learned a lot today, and I hope all of you guys learned as well. And you know what? I will try to do this, every other call. And this is what I love about it, because I think we all learn when we can hear of a real project out there, right? And what these operators are doing, and how, if you want to invest it, I think it gives you that sense of, okay, they know what they're doing. This is great. Obviously, you still, want to dig and get more information. But let's say you're doing something on your own. I think you can take away from here, right, and implement those things for yourself. So I hope you guys found this valuable. I am, I'm here every Wednesday at 2 p.m. and feel free to join, come back and bring questions, opportunities. Definitely email me, and I will see you guys next week.
All
Thank
right.
you so much.
Okay, Dee Dee.
Take
Bye-bye.
care.
Thank you.
Bye.
Thank you. Bye.
Bye. Thanks for joining.
Thank you. Thank you for all the information.